Hey, on today's video, we are going to think a little bit about how you build a portfolio to help you rock retirement. Because most likely, if you're over 50, you've been investing for decades to grow your assets. Well, the rules you follow to do that may not be the right rules to set yourself up for successful retirement. So let's go dig in. Hey there, I'm Roger Whitney. I am host of the award-winning podcast, The Retirement Answer Man Show, author of the new book, Rock Retirement. You can get that anywhere. And a financial advisor that has walked the journey into retirement with countless clients over my 27 years. I mean, retirement is all that we do. And I was having a conversation with a newer client talking about an important transition that we make when we're going into retirement, especially when it comes to investment management. And it usually surprises people, and it makes sense after you hear it, but most people, unfortunately, never hear it. So if you're in your 50s and you have been investing for decades, sacrificing your lifestyle to save for tomorrow, you have been accumulating wealth, right? With the hope of rocking retirement. So you've probably heard this through things that you've read, or maybe with your advisor or your online account, is when you're investing for accumulation, here are the rules, right? You're going to be investing for a very long period of time. That's really important, right? You got a long period of time, and you're going to be contributing consistently to IRAs and 401ks and after-tax accounts. So you really need to embrace volatility in order to position yourself to grow your assets so you can rock retirement, right? You got it. You have to embrace risk or volatility, because that is going to position you for the long-term investment success. Now, why do we need to embrace volatility when we're accumulating assets? Well, most likely you've seen or heard about a chart like this, right? This is the long term, and over the very long term, stocks greatly outperform bonds or other safe investments, right? So over the long term, history has shown us that. But the price you pay for investing in stocks or other riskier investments is that, well, we know if we've lived through 2008, right? They move up and down, they go all over the place. So that can be uncomfortable. So the model that is used to help build portfolios for this accumulation stage of life is something based off of what's called modern portfolio theory. I'm not going to bore you with going into that, but on a very basic level, and you've probably filled one of these out, you take a questionnaire online or with your 401k or with your advisor, and it asks you questions like, how long term are you? Are you contributing money? How would you react if this happened? When do you think you're going to tap this money? Questions like that. And there's usually 10 to 15 questions. And that's called a risk-tolerant questionnaire. Now, what's happening in the background of those questionnaires that you fill out is that each one of those questions is scored. It has a score value based on your answer. And that comes up with something called your risk score, which says this is how much risk you can tolerate. And they put that into a computer model, and then that risk tolerance builds your pie chart, right? Your asset allocation. If you have a 401k, you've probably completed something like that. And the goal of that asset allocation is to position you for success based on how much risk you can tolerate as an investor. So to say that another way, and this is the science of portfolio theory, we're not going to get too boring here, I promise, is it wants to maximize return for a given level of risk to be efficient. And to say that a different way, it wants to minimize risk for a given level of return, which would be something a rational person would do, right? If I'm going to take risk, I want to be paid for the risk that I'm taking in the form of potential returns. And if I get certain amounts of returns, I want to try to minimize as much risk as I'm taking, because why would I take risk otherwise? That makes total sense in theory, and that is the best practice of the industry in the accumulation phase. But here's the thing. If you're in your mid-50s or you're getting ready to retire, you're leaving the accumulation phase and you're entering a phase when you really want to turn on the power of whatever assets you've accumulated to support the life that you want. Nobody in our industry has ever solved for that in some consistent way. You, my friend, are part of a grand experiment because your generation is going to live longer, spend more money, doesn't have a pension, and be more active than any generation in history. And nobody has a solution. So what we use as a best practice, is that same accumulation model of risk tolerance equals your pie chart and let it go along the way. So the question is, how do we solve for that? Is that really the best way to build a portfolio? Now, I'm not going to tell you I have all the answers, but I think we need to think intelligently about this so we can come up with a solution that fits you so you can rock retirement. Let's go check that out and figure out how to do that. So in talking with this couple that I mentioned earlier, we got to the point in building their retirement roadmap where we had outlined their ideal retirement. We had talked about their financial resources and done a number of other things. And we were focusing solely on what kind of portfolio they should use. And of course, they came with a portfolio that they had built over time using another advisor that was not in the picture at this time. And so we're talking about it, and they were very comfortable with risk. They're comfortable with markets going up and down and everything else, and it's actually worked out really well for them over time. But now they're 59 and they're trying to figure out this retirement thing. So I brought up the concept of, okay, great. You have built this portfolio to accumulate assets because they were following the rules of accumulation that we talked about. But now we need to make a decision of, do we continue with that framework or do we rethink it? Because retirement has its own rules that are very different when you're building a portfolio. The assets are about life, not just growth, right? It's about turning on the utility of all this money that you've accumulated over time. So first off, it's about achieving the lifestyle that we had worked to define together. Number two is we're not having contributions go into the account consistently like you've probably done for decades. And in fact, you may be systematically withdrawing from your assets, reverse dollar cost averaging, taking money out. So the bigger rule is not so much to embrace volatility, which has been the rule for accumulation, but to embrace consistency. Right? Because those are the different rules. We built up all these assets. Why do we have them now? We got to use them. And still, the general practice is to do the risk tolerance, to get your pie chart, to position you at the risk tolerance part of your portfolio construction. So let's take a second here. What does risk tolerance mean? What does tolerance mean? So let's look at the definition of tolerance. And I talk about this in my book, actually. Shameless plug. Tolerance is the capacity to endure pain. Okay, well, when you're young and you're contributing, the more pain in terms of volatility, the better positioned you might be for growth. And the other definition is what? The act of allowing something. So this whole idea of risk tolerance is literally to find out how much pain you can handle in terms of markets going up and down and build a portfolio to maximize return for that level. And another way of saying that is to position yourself to ultimately endure that maximum risk tolerance, right? Statistically, you probably will if you implement that portfolio. And that might be great when you're younger and you have plenty of time of investing, right? You just stop looking at the statements. But when you're not working, you're taking money from your assets, tolerance really doesn't have anything to do with anything. I might be able to tolerate punching myself in the face 10 times, but it doesn't mean I want to position myself to actually endure it if I don't have to. So I think when you're building a portfolio for your retirement, tolerance isn't necessarily the best word, because tolerance has nothing to do with your life, right? And retirement is about living, enjoying the fruits of your labor. So I want to introduce another word that we should consider in building a portfolio for your retirement. How about the word utility? Fitness for some purpose. Something useful. Rather than build a portfolio based on what we can tolerate in terms of pain, aka volatility, why don't we think about how do we build a portfolio designed to position us to achieve the life that we've designed? Doesn't matter what you can tolerate. You've told me this is the life that you want. That's what your ideal is. Shouldn't we just focus on that? So how do you do that? We looked at the analysis with the client. I'm just going to show you a little bit. Obviously, there's a lot that goes on underneath here, but we modeled out their cash flows, looked at their resources, and we used something called Monte Carlo analysis, or stochastic modeling if you want to get fancy. And it gives a probability of success, okay? So I'm going to show you this probability of success. I'm going to hide something here because I want you to see it on the front end. So here was the probability of success, 93%, using their current portfolio, which was about 70% in stocks, okay? And so based on the cash flows and a bunch of assumptions, we said, okay, you have about a 93% confidence level with your current portfolio. You could achieve that. 93%, that's pretty awesome. And then I showed an alternative which had the exact same confidence level, this 93%. So they seem to be equal, right? 93% confidence here, 93% confidence there. But then I showed them that their portfolio of about 70% in stocks and the rest in fixed income, and obviously there's lots of assumptions here, that would get us to 93. And the one that I was showing them was much more conservative. And then I showed them that 93% confidence level. But what I also showed them right next to it was what that allocation did during the Great Recession, which was October of 07 to March 9th of 09. Their current portfolio from peak to trough during the Great Recession lost 34% before rebounding if you had stuck with it. The portfolio that we were considering with the same confidence level of achieving their goals, peak to trough, was down about 15%. Down less than half of what their current portfolio does, right? But from a confidence level, gave them the same confidence statistically of achieving their plan. So they've obviously been able to tolerate the risk of their current portfolio because they've invested in it for years, and that's what got them to where we are now. But now that they're going to stop earning money, which psychologically is very different for us, they're going to stop investing, which psychologically is very different with us. They're going to be taking money from their assets, which psychologically is very different for us. All of those things put us at risk and make us more sensitive to things going awry, right? We feel out of control. Where would be the point from a investment standpoint where they make a bad decision? They say, I'm done. I'm out. I can't handle that ride anymore, right? That tolerance may be very different. And the idea of utility, if I can achieve the life that I want with taking a lot less risk, why wouldn't I? So my counsel to you is, when you're getting ready to transition or transitioning into retirement, you need to think about how you're constructing this portfolio, because the rules of accumulation may not be the best rules to follow to position yourself to rock retirement. Does that make sense? I would love to hear your comments below. I would love to hear how you're building your allocation to serve you in the comments below. If you're enjoying these videos, please subscribe. It helps other people find this so we can all work together to rock retirement.